Welcome to your first review session for financial accounting and reporting. As a welcome treat, we shall go back to the very beginning. And in financial accounting and reporting, that is the conceptual framework for financial reporting. Ready your notebooks and your pens, and feel free to take down notes as we go along the way. Let's get started with a few fun facts. Do you know that the conceptual framework for financial reporting, or the framework as we know it, actually dates way back 1989? Back then, it was still called the Framework for the Preparation and Presentation of Financial Statements, and was approved by the IASC Board in April 1989 and published in July of the same year. In September 2010, it evolved into what was known as the Conceptual Framework for Financial Reporting 2010 as approved by the IASB. And finally, in March 2018, it was rebaptized and published as the Conceptual Framework for Financial Reporting 2018. This version of the framework will of course be the focus of our discussion. Just like any getting to know you phase, let us first understand the status and purpose of the conceptual framework. What is it for, and what purpose does it serve? Well, the framework exists for three main purposes. First, to assist the IASB to develop IFRSs that are based on consistent concepts. This means that whenever new standards or revisions to existing ones are submitted to the board for consideration, they consult the conceptual framework to ensure that it is consistent with its provisions. Second, to assist preparers to develop consistent accounting policies when there are no standards that would apply to a particular transaction or event, or when a standard allows a choice of accounting policy. This means that, aside from assisting the IASB, the framework also assists preparers of the financial statements in its choice of accounting policies when no guidance is available. So, when management finds itself confused as to how to account for a specific transaction, the rule of thumb is look for the standards. If there are none, consult the framework. And third, assist all parties to understand and interpret the standards. As we can all see, it is very clear that the framework is not an accounting standard. Yes, a framework is consulted whenever a new standard or a revision to it is being considered. Yes, the framework is also consulted when there are no standards that would govern a particular transaction or event. And yes, the framework will help us understand and interpret the standards. But the framework is not a standard. Therefore, can the conceptual framework override an accounting standard? The answer is no. And so if there is a difference between what the conceptual framework says and what the accounting standards require, which do we follow? The accounting standards or IFRS, of course. Is it possible for an accounting standard to contain provisions that are not consistent with the conceptual framework? That's a tricky one. But the answer is yes, but very rarely does this happen. You see, in very rare instances, the IASB may sometimes specify certain requirements that depart from some aspects of the conceptual framework. If this is the case, the board will explain the departure in the basis for conclusions of that specific accounting standard. Considering the quite exciting journey that the framework has taken from 1989 to the present, perhaps you have wondered about how often can the conceptual framework be revised. Also, what happens to the existing standards once the conceptual framework is revised? Well, the conceptual framework may be revised from time to time on the basis of the board's experience of working with it. Revisions of the conceptual framework will not automatically lead to changes to the standards. The decision to amend a standard will go through the usual process undertaken by the board and does not automatically result from a framework revision. Now, speaking of standards, do you know that the conceptual framework serves a very noble purpose in standard setting? It is the vision of the IASB that the conceptual framework provides the foundation for standards that contribute to transparency. This is done by enhancing international comparability and quality of financial information. Strengthen accountability by reducing information gap between the agents or management and the principal or the stakeholders. Contribute to economic efficiency by helping investors and providers of capital in identifying opportunities and risks. Now that we have taken a look at what the purpose of the conceptual framework is, let us try to visualize how it is structured. The conceptual framework is actually made up of 8 chapters, and these are the 8 chapters. Because I do not wish to overwhelm you by delivering all 8 chapters in one video, I have decided to divide our discussion according to the chapters. But before we do that, let us first summarize the key points or the major takeaways from this video. The conceptual framework is not a standard. Nothing in the conceptual framework can override any standard or any requirement of an accounting standard. In other words, the accounting standards are still more powerful than the conceptual framework. The conceptual framework assists the board or the IASB, the preparers of the financial statements, and all other parties. A revision in the conceptual framework does not automatically revise a standard. And accounting standards are intended to contribute to transparency, strengthen accountability, and contribute to economic efficiency. Alright, that's it for this video. Whenever you are ready, I'll see you in the next video on Chapter 1, the objective of general purpose financial statements.